1913, they had gotten, what was it? Can't remember. 32 million in deposits, but the customer base surprised everyone. Quoting one 1913 administrator, the postal savings system was extremely popular everywhere except where they expected it to be popular. So it wasn't the South and the West, it was recent immigrants coming into the ports, and the post office would meet them at the ports and give them these brochures in 24 different languages. And of course, these immigrants were coming from European countries where postal banking was something that they recognized and they trusted it. So they flooded the post office with their deposits. And then this changed, though, during the Great Depression between 1929 and 1934 as banks were failing. We didn't have deposit insurance yet. $1.2 billion goes from failing banks to postal banks. Deposits in postal banks doubled each year from 1929 to 1934. And they would have kept doubling except for FDR, given the chance between bolstering the postal banking system or choosing FDIC insurance, reluctantly chooses FDIC insurance. And this was because the South had a lot of influence over the New Deal era legislation in other fundamentally problematic ways, but in this way, they pushed hard for FDIC insurance. So once there's FDIC insurance, deposits are basically secured. There's no need for the postal banks. However, FDR switches the mission, brings the money back to Treasury. In between 1940 and 1941, deposits roll up because they start saving defense savings stamps at the post office. And FDR is able to raise $9 billion from the postal bonds to pay down the Great Depression debt and to fund the war. They innovate banking by mail, so the troops abroad, mail back their money through the postal banking system. So this was the peak of the postal banking in the U.S. is 1947 at 3.4 billion deposits and 4 million users. After that, there's a swift decline starting in the 1950s. This is the golden era of community banking, right? This is George Bailey. There's banks everywhere. Banks are paying 3%. But deposits at postal banks are still capped at 2%. So deposits flow out. It's not until 1966 President Johnson ends postal banking to sort of streamline the federal government. So it dies a quiet death. No one really says much. Excuse me. I think it was it was one of our nation's most successful efforts of financial inclusion, specifically at savings. And there's research that shows that Japan and Germany, they kept their postal banks while we lost ours, and that may have contributed to the savings cultures in those countries where we have lost ours. And so one of the proposals here is that by offering a cheap savings account, even not just deposits, but possibly bonds, right? Like making the bond sexy again, right? Would be one way to help low to mid-income families save their money in a cheap way. And once you have savings, maybe credit becomes less of a demand. And I don't have firsthand research on this, but there are some folks at Harvard Business School that are suggesting that this might help the bond to help savings. So the proposal here is that the post office could again offer savings, money transfer, checking to fill that need with the unbanked. There's also a proposal by me that they might consider credit products, but this is also quite controversial, so I'm going to leave that. The paper that I'm going to write here just talks about the international angle, and there's many ways to do this. One is to partner with existing commercial banks, and the other is to go it alone. I think the latter makes more sense because it is backed by the Treasury. We don't need the FDIC insurance, but there's a variety of models that I'm still exploring about how this might work. This one, I think.
Yeah. Okay. So I am a sociologist by training, but I teach here at Duke Law. And this project started looking at credit reports from a study I did in the past interviewing earned income tax credit recipients. So families who receive the earned income tax as a new safety net as welfare in 1996 was reformed. And in that city, I proposed taking part of the earned income tax credit, about 20%, saving it so that we've talked a lot about today. When people experience some kind of financial shock, they have a cushion so that they are not pulling on some of these other high-interest loans. Senators Booker and Moran have proposed that. As I've done more research, a version of it called the Rainy Day Earned Income Tax Credit, but as I've done more research, I've become convinced that that will help a small segment, but that more is needed given what has happened to our welfare system. So I wanted to start by telling you a story of someone I interviewed, Letitia. She had been on welfare when she was in her 20s, and she was making just enough money to get by. And she had a side job. There's been research that wasn't reported, and that helped her, but she was just making it. And after welfare reform, she found a job through a kind of job training program. And now we just celebrated the 20th anniversary of welfare. She's in her 40s, and she's really struggling. She's $10,000 in debt, mostly with credit card use. She lost her job about 6 months ago. She worked for a small business that downsized. And what was interesting to me during the interview is she kept targeting the credit report as her problem. She's applied to more jobs. She's been told she didn't get it because of the job. She tried to move to a less expensive apartment. The credit didn't check out. The landlord said to her she couldn't move, and she's not sure what she's going to do. But the interesting thing about Letitia is that despite her problems, she's actually really the poster child in some sense of welfare reform. When I asked her about welfare, she said, I hated it because I was needing a handout. And she also, we heard about this in terms of bankruptcy earlier, but this is not just my work. Other past work have shown that she also created boundaries between herself and other welfare recipients and said there were so many lazies who sat around getting fat, eating Doritos. I was stuck because my son had bad asthma and was always homesick. So, and the image of the welfare queen, which both the media and Ronald Reagan kind of publicized, she has really internalized that image and wanted to make clear that that was not her, that was other people, even talked very specifically about neighbors across the street who were clearly that, but that was not her. And now when she talks about her life, she makes sure to say, I really take care of myself. I teach my boy that. You got to figure things out for yourself. Don't ask for a handout. And this is a big part of her identity now, that she does not ask for handouts. And this fits right into what welfare reformers wanted. People who have the sense that I'm not going to just this culture of dependency, I'm not that, those were the catchphrases, making work pay, economic self-sufficiency, personal responsibility. That was what was popular. If you go back to the history of welfare in the 1930s, it was created for single mothers so that they did not have to work. That was the idea, but as time went on, as the media portrayed welfare queens, the tide changed, and it was iffy, but there was bipartisan support. We have to do something. And in fact, in the 90s, people like Letitia and research shows most people receiving welfare did not like it. And there were disincentives to work. Kathy Eden's work showed that people were working on the side, but not reporting it because they knew that then they would lose the money. So I'm not at all arguing that that's what needs to happen. But there was a lot of hope for welfare reform will transform a broken system that traps too many people in a cycle of dependence, right? That's what Bill Clinton said. And we're going to give people a chance to work, get a paycheck. This is going to be great. And so AFDC, which was an entitlement program, turned into TANF, Temporary Assistance for Needy Children. And as part of TANF, there were time limits on welfare, and states received block grants. And the idea behind the block grants, if you look at it historically, was that they would work on jobs. And the block grants would give states flexibility to help with jobs. So in case you don't know, TANF's role as a safety net continues to decline, just going down and down. You can see the Center on Budget and Policy Priorities has done a lot of work on this. They just released a lot of new data. 82 of every 100 families in poverty received it. In the 80s, we're down to 23. So it's really not a big part of the safety net anymore. It's less responsive to joblessness among single mothers. You can look at this chart. and see that pretty clearly. It's going down as the rate of single mothers who are not employed are going up. And it responded only modestly to the recession. So you can see here, you would expect the rates to go up as people were losing their jobs, but it's only very slight. And we also know, we've heard today, income volatility is increasing. Bruce Western and I'll have an article in Demography that shows that particularly for low-income families. And past qualitative work, mine, other people's, have shown that shock events for families who are earning the earned income tax credit, who are working, can really tumble them into homelessness. You have a $500 car repair you can't pay. You then lose your job because you don't show up to work. Then you can't pay your work, and you can't pay your rent, and it just kind of cascades into bigger problems. And it really started as this one large, but you would hope correctable expense. But we know that now, if you look at even just the numbers, the earned income tax credit is really the new safety net for workers. And the new safety net actually provides a lot of help for people who are working. But if you're out of child care vouchers, all sorts of things. But if you're out of work, you're really out of luck. And then you look at Tanf, and you look at how states spend their Tanf money. And what is somewhat surprising, this is a bit hard to see, is that basic assistance, cash assistance, is only 26%. Child care is 16%. Work-related activities, the idea of block grants, only 8%. What states are doing, a lot of states are spending some of the money on the child welfare system, so child abuse and neglect. They're spending money on college scholarships for low-income women, with the idea that this will reduce teen pregnancy. That's a justification for it. But basic cash assistance really is just a small part of this. And you can think of credit cards. I've talked about this before. Angie's work has shown this, in some sense, as a new welfare providers. They're used when people have a problem. They turn to credit cards. They're reliable. A lot of people talk about credit cards as emergency credit cards. So they use them only in emergencies. Then they have an emergency. They lose their job. They max them out, or they come close to it. There's also work to show people when they lose their job, they're doing things like selling plasma. You can't sell your blood, but you can sell plasma. So welfare is not a part of the story anymore, but they're trying to find ways to make do. And in this context, interviewing a lot of low-income, so I limited this to women who have children under 18. So this is not the whole universe. This is women under 18. Again, the credit report just comes up again and again. And in fact, credit reporting, as we know, is a huge multi-million-dollar industry now, and it's only growing. And if you go to the websites of the three big credit reporting agencies, they are all trying to sell their services to landlords, to employers. Here, every time you hire a new employee, you put a lot on the line. The wrong decision could jeopardize your firm's assets, reputation, security. So, use us, look at credit reports. And in fact, there is not good research about how employers look at credit reports, but we think about 50% of employers use credit reports. I have a different project where I'm surveying employers to try to figure this out more. Landlords are using credit reports, insurance rates we heard about earlier, also utility companies. So also for a different project, I've been talking to families who live in hotels in Durham, and it turns out that they are paying more money to live in a hotel here than they would be for just sort of low-cost housing. Durham is not a high cost of living, and the reason they do that is because utilities are taken care of, and they can't get utilities because utility companies, if you have bad credit, either say, give us a big deposit, which they don't have, or have someone guarantee us, and if they don't have someone to do that. So this is a big problem for low-income people. And what I found in my interviews is that people are talking about credit reports as the golden ticket. Here you can say, Letitia, the freaking score, I can't win with it. I need to fix it. It needs to be better. Find a way. God, lead me to find a way. You see that Charlie and the Chocolate movie? Well, a good score, it's my very own golden ticket. And I heard this again and again. The most important thing in my life, the damn thing destroying my life, this credit report, at least in their minds, was a big ticket. And so what I found, what I wanted to try to figure out is, we know how credit reports work, and we know what the safety net is like now. How are people thinking about when to seek help and how it's going to affect their credit report? And I found that there are three main groups. And the group like Letitia, who have most kind of internalized the welfare reform, I can do this myself, I don't ask for help, they're worse off. And that's not surprising. If you just look at how credit reports work, that makes sense, because they're not, one woman was talking about, she doesn't even let her children eat free and reduced lunch because she doesn't want that stigma. So the group that is most worried, and everyone in my sample, by the way, qualifies for free and reduced lunch for their children. So the people who don't want the stigma of asking for help, they try to smooth it in these ways that may seem completely irrational as their score tumbles more and more. But in fact, to them, it's perfectly rational, because that's not who they are. And meanwhile, if you think about what I told you about Letitia, they are applying for jobs, not getting the job because of their score, can't get a housing situation that works, utilities, and all of that. That also, another piece of this is debt settlement. So a lot of them see debt settlement as a way to do this that's not something like bankruptcy. It's a responsible thing to do. And if you look at advertisements of debt settlement companies, that's how they portray it. This may be a separate paper because there's so much there, but they are going towards debt settlement companies or consolidation. They're very confused about what it is, but that's what they're doing. There's a middle group, I know I'm short on time, who eventually go for help but are very embarrassed about it. And one of them said, can we turn off the tape recorder because I might go find out about welfare again? I don't want people to know that, but I just am bottomed out. I don't know what to do. Another person talking about bankruptcy said, I don't want anyone to know this, but I might have to do it because I just don't know what to do, always focusing on the credit report. And then there's another group who is just different, and they say, what is out there for me? And what's interesting about that group is that they, in terms of their credit report, talk about it less as a barrier. And it's partially because they have gone to DSS, Department of Social Services. They've gotten whatever Tanf funds are available, charities, those kinds of things. They're really taking advantage of these kinds of whatever social safety net they can get. And for them, that group has not talked about their credit reports as much of a problem as the other groups. But one thing to note with all three groups is that confusion abounds about credit reports. So a lot of people talk about the way they're going to get their score up is no more borrowing at all. They're done with any kind of borrowing because that's what got them into trouble. And that, you can see this first quote, no more borrowing for me, I cut them up. It's all me, you don't take other people's money, then my score will be at the top. And also another quote about paying all cash for condos. That's how rich people do it, so I will only try to buy a home if I'm in a situation where I have all cash. So while we know that financial education is not, there is mass confusion, at least about credit reports, and also banks. So a lot of people in my sample have had a lot of bad experiences with banks, and so they have written banks off. One of them talked about, I'm just going to use my bank for emergency stuff. Most of my sample is banked, partly because that's how they got their paychecks. They were direct deposited. But whatever, me and banks, we really don't get along. I can't do checks because I'm bad with subtracting, and just story after story about how banks don't work for me. And lots of people talking about money under the mattress is the safest place for it to be. That way they can't take it. And that if you have it in a bank, poof, it can just disappear. And you didn't even realize it disappeared. So essentially, another thing to consider is with all of my studies at the end, I always say to people, do you have any questions for me? And this started with the EITC study, and then in this study is playing through too. What people always ask is, do you know of anyone who can help me? And with my financial problems, who's not welfare and who's not the bad guys. And, some people maybe Duke has someone like this, but, I'm not sure what to do. What about debt settlement? Are they really the good guys? Or are they not? And so I have a proposal that I won't go into about what we should do with welfare. We should TANF funds, instead of spending them on college scholarships and the child welfare system. Let's spend that money on financial services for the group that is supposed to be receiving TANF funds. Okay.
Hi, everyone. My name is Xiao. I'm a JD PhD candidate at Vanderbilt Law School in the Law and Economics program. Today, Paige Skiba is also here. She's my co-author and advisor for my dissertation, and we're really excited to present our joint work. And we first want to, just like the others, thank Jim or the other organizers and Duke for putting on this symposium. Consumer litigation funding is a type of alternative credit for personal injury plaintiffs. And it's a type of credit that's been quickly growing in the last couple of decades. Opponents of this funding have compared it to payday lending, which we know from today's presentations, payday lending has quite a bad reputation. So Paige and I thought we'd do a comparative piece. So we first are starting out with some basics, functional similarities and differences, and for the sake of time, I'm not going to explain payday lending. Nick did a pretty good job of that earlier today. I'm going to explain what consumer litigation funding is. So suppose I get in a car accident and I'm out of work, I don't have enough money to pay my bills, my car is a wreck, and so I go to a consumer litigation funder. I fill out an application. The application focuses on case characteristics, and I'll explain in a second why. I get a cash advance, somewhere between $500 to $200,000, with the average probably being on the lower side. And the cash advance comes at a pretty high price. Commentators have said anywhere from 2 to 15% per month, can be compounded, can be a flat rate depending on the financier. And so what's unique about consumer litigation funding is not that I get upfront cash, but it's that the repayment of the advance plus interest and fees comes out of the lawsuit proceeds. And a unique feature of funding is that it's non-recourse. So at the end, when I get my settlement, the money comes from the defendant, goes to my attorney. The attorney sets aside, say 30% for attorney's fees, and then sets aside money for other debts that might take priority, like child support liens. And out of what's left over, out of that leftover portion, money goes to repay the funder. Now, if that leftover portion is lower than the total amount owed to the funder, then I only have to pay the leftover portion. And just to emphasize, that's a stark contrast because it's non-recourse, there's not a possibility of getting into the type of debt trap that we see with payday lending. Okay, so this is a table we put together, and I'm so glad Nick presented, because for the payday loans column, this is showing usage of payday loans, and that data is actually from the Pew Charitable Trust study. We got data from a national legal financier. They asked consumers to write a few lines that consumers could put down what they're using the funding for, and we were able to get sort of a breakdown of what consumers were using their funding. And the really main point of this slide is to show that payday loans and funding are used for similar things, namely living expenses, so utilities, car payments, mortgage, rent, food, etc. And so I guess this is one of the key benefits of the alternative credit source, that it's providing money to consumers who really need it. So a lot of states are currently looking at how to regulate funding. And what's really important when you think about regulation is how do consumers respond to the financial product? I'm a consumer, I take the cash advance if the benefits are greater than the cost. As we discussed today, consumers can be susceptible to shortcomings and biases. So from our knowledge of the behavioral economics literature, we compare funding to payday lending. We come up with three arguments here. First, the costs of funding are less salient, and the reason for this is with payday lending, the consumer knows that the money's coming out of their bank account. There's not really secrecy or shrouding there. With litigation funding, it can be harder from a behavioral perspective because it's not as salient that the settlement or trial award they're getting is income. A lot of consumers may have a different mental account, thinking that settlement or trial award is a separate account than their current cash flow, which we know is not true because settlement and trial award is making up for lost income. Second observation is funding leads to little or no pain of payment. Like I discussed earlier, most of the time the attorneys are dispersing the repayment to the financiers, and because of that, the consumers aren't, writing the check, they're not seeing the money leave, and so they're not experiencing that cognitive pain from, paying for that financial product. And as opposed to payday lending, where consumers are writing down the check, they see it, their money goes out. And the third point we wanted to make is funding complicates the repayment calculus, also due to its tie to litigation. And I want to just give an example here. So suppose that I get $1,000 funding at a 6% monthly flat rate. A lot of states that have input disclosure regulations mandate a schedule of repayments similar to the one I'm showing you now on the PowerPoint. And this is a very clear schedule. That's not to be denied. However, we believe that if a plaintiff saw this, they still wouldn't know what the actual price of funding is. They don't know where, when the case is going to end, how much they're going to get in the settlement or trial award. So they really don't have a sense of what they're giving up to obtain the cash advance. So the third portion of our paper, we look at how states have regulated payday lending, and we think about how analogous policies can be applied to funding. So with bans, at this point, we don't think bans are the solution. From an economics perspective, we only want to implement bans if costs are greater than the benefits of the financial product on net. And there's currently no empirical literature on how funding affects consumers, consumer outcomes, consumer welfare. And the industry has really quickly developed, but we believe it's still growing and prices haven't reached an equilibrium yet. And the second type of regulation would be restrictions on loan characteristics. States, so to give an example, states have tried to regulate the duration of time for which funding can receive, or financiers can receive interest for the cash advance. And we don't think that this is the ideal policy for a few reasons. One, it's just hard to implement. It's hard to find that optimal, duration of time that's going to maximize social welfare. Two, it might adversely impact different groups of consumers. So we could think that financiers, in order to comply with the law, they're only going to give cash advances to consumers who fall within that range. So that they expect their case to resolve within that duration of time. And three, it's not unimaginable to think that financiers might try to get around the policy, as we've seen payday lenders try to evade laws. But here I'm thinking more of in the profit maximization sense. If they're only allowed to charge interest during a specific period of time, what's to stop them from, hiking up the interest rates during that duration of time? And when you regulate on one loan characteristic, you got to think about how financiers might adapt to that. So the third set of policies we consider, or the final set, is disclosure regulations. Payday loans are subject to the Truth in Lending Act. Funding generally is not. And that's because the status of funding as a loan is currently being litigated. It's been litigated in the past decade, different states. And if it is found to be a loan and that state credit, and the state's credit law incorporates TILA provisions, then it's subject to TILA, but generally it's not. Some states have just regulated funding independently through their own bills, and they have mandatory funding disclosures, like I give a few examples of the things that they require. along this, it can be thought of similar, Tila, you're disclosing the one-time fees, the scheduled repayments like I showed you, and the APR. And our perspective is that the current disclosure regulations that states impose aren't enough for the reasons that we talked about before from a behavioral economics perspective. And we are contemplating a few solutions. Love to hear, comments and suggestions at the end. One is in response to cost of funding not being salient, it would be to explain to consumers that this is really coming out of their income. One of the things that's happening is sort of going back to one of Paige's comments is that when you're looking at a market, consumers will look at the reference good in the market and look at a characteristic that is standing out. And one of the things that stand out is that the repayment comes out of the lawsuit. And for a lot of consumers, that's the part that's really emphasized and salient in their mind. And so they're not thinking about how it's affecting their income, their cash flow. And so helping them to really understand that would be helpful. The second point on the pain of payment, it might be good to have the plaintiff be present with the attorney when they're dispersing the funds so they can see, this is a lot of money going out for advance, just so they can understand what they're paying for it. And on the third point, we think that it would be good to disclose case duration and value estimates. So going back to our example here, suppose the plaintiff is expected to get $10,000 in settlement in 2 years. And from the repayment chart, we can see that would be $3,400, $2,400 in interest. That'd be 24% of the settlement. And so if a consumer has this approximation, in 2 years, I got to give up about 24% of my settlement in order to get this upfront cash advance, we think that that would give them a greater understanding of what the costs of funding really are. And just to finish up, just a couple brief remarks about such a policy. We recognize there's a cost to building data systems to be able to have this estimate. So we think that there should be some sort of phase-in period, but it's not impossible because if you look at the insurance industry, they have huge databases. And the second thing is we list a few reasons why we don't think attorneys should be the ones to bear the cost of giving precise estimates. And one of them, just list one, is the transaction cost. If the attorneys gave this estimate, the consumers would then have to put together what they learned from the funder. And as research shows, U.S. consumers, there's many of them who aren't financially literate and not sophisticated or even motivated enough to do that. Okay, thanks for your time. Look forward to hearing your comments.
So we have about 15 minutes for comments, so I'll open it up. Angie?
Sara, I'm working my way over. Sara, I was really struck in your paper, even before you got to the last slide about people having questions about your IRB obligations to provide resources at the end. And it seems like an overwhelming challenge to provide information and resources in these things. Do you have to disabuse people of how credit reporting works? So I just want to hear you talk about that. And then next, going down the line, the postal banking was really fascinating. I am wondering, what are the factors that decreased community banks, and are they going to be is postal banking subject to the same forces? And then finally, Gina and Paige, what is the relationship between trial attorneys and this litigation funding?
Okay. So at least I don't think that there is a specific IRB requirement beyond I pass out a sheet that gives legal aid and some other, in North Carolina at least, they do consumer issues. It was a sort of, I went from being a lawyer and doing kind of public interest to doing these kinds of interviews, and what was tough for me is like when I first started them at the end after I turned off the recorder, started to talk to them about some of these things, and as time went on, that I did that less because I think there are also, as a researcher, I can't give legal advice. And so at least our IRB doesn't see that as I think if you think about IRB and the kind of mass benefit by collecting this data, hopefully the system will be better.
So the question is a very good one. Trends that worked on community banks and whether the postal banks will be subject to that. And the answer is yes and no. One is that the community bank consolidation sort of over 30 years is both deregulation and market changes. And the market changes are that you need scale to overcome some of the barriers to banking. And so this is one thing that the post office, so I'm exactly trying to counter that trend, right? So it's either, and I say this, very openly, it's either going to be the postal bank or Walmart that is going to meet this market. And I'm sometimes ambivalent about it, but mostly not, right? Because Walmart is doing it. Walmart is underpricing these mom and pop so-called community bank or, lenders. So that's one, but the other is, yes, the reason why community banks leave these areas is because small accounts are unprofitable, right? So a bank needs $2,000 to break even, a deposit of $2,000, and anything under $700, that costs a bank money, okay? And so that is a trend that the Post would have to deal with, but I think there's thought it through the business plan, and I think it makes sense as you have scale and scope to overcome that cost. And so I think, yes, it's a very good question.
I have 3 points I want to answer your question with. One, the ABA did a report 2011 that says basically it's against the model rules for there to be a formal referral relationship between trial attorneys and funders. From talking to some funders in the industry, some funders do use the attorney as a way to sort of get the word out there that there's this service for plaintiffs and a way to tap into the market, if you will. And sometimes there might be some perhaps informal referral relationships, but not to the point of being egregious. And then the third point I wanted to make is that some states have put in their statutes that it's a requirement that attorneys disclose or attorneys sign verifying that the consumers understand the terms when working with a funder. And from my research, that still with attorneys signing, the consumers are not they're not getting like a case value or estimate. So that's still an issue.
Litigation funding should be TILA disclosable credit.
Well, yeah, so as Jean said, it's an open litigated question whether these are loans or not. They have this non-recourse nature that makes them quite different than any other sorts of credit that we've talked about today. I certainly think in the minds of the consumer, they're a loan. You're getting money and you have to repay with interest. So the comforts that TILA affords to other kinds of users of consumer credit, I think, should also apply to consumer litigation funding. At the same time, I'm probably like Lauren, I'm very skeptical in most cases of disclosures and financial education and literacy work. But at the same time, because the litigation process is so opaque and confusing and uncertain and ambiguous, I think if there is a case to be made for some disclosure to help consumers make decisions, consumer litigation funding is an area where people probably could benefit from better estimates of how long they're going to have their loan outstanding and how much of the proceeds they'll get at the end. So, Lauren?
So I already sort of talked about this with Paige a little bit, but maybe you have some thoughts about it. So one is the pain of paying after the fact seems gratuitous to me. You want the pain to be upfront so that they can make a decision knowing what the pain's really going to feel like, not just to punish them at the end, right? And the disclosures, one thing I was thinking of was trying to display the information, even though I'm skeptical of disclosures, but doing some kind of if part of what you think is that people don't understand how much of their settlement's going to be taken away, to do some kind of pie chart kind of thing that might be more effective than like APR or something like that, that shows like this amount's going to your attorney, this amount's going to go on sort of an average or expected duration of this type of case loan and expected recovery, and so this will leave you with this so much money. And the other one is the one I suggested to you before, Paige, that perhaps litigation funding should be done on a full contingency basis, not just non-recourse, but that the funding itself should be contingent.
Yeah, great. So we're trying to think through exactly how, our policy instruments would work. And so I think those are great suggestions. I guess one follow-up, maybe this is back to Chris's point, is that I think Colorado is the only state that has said, yes, consumer litigation funding is a loan.
At the Supreme Court level.
At the Supreme Court level. In other states, there's been legislation that it says explicitly, we call this funding or legal finance, therefore it's not subject to the rules of other consumer credit laws. In those cases, actually, then there's more bespoke legislation that seems to be tailored specifically to litigation funding, which may in fact be, well, I just said I think this seems like a loan, sounds like a loan, is probably a loan. In the cases where it has explicitly been called not a loan, then the rules and regulations specific to legal finance or litigation funding, whatever you want to call it, actually might be better for consumers. It's still an open question, but yeah.
Lauren, I just want to follow up to something you said about the contingent basis. There are these old common law doctrines against sham pertain maintenance, and so the evolution of the industry has been such because if they did take a percentage, it would be likely under those doctrines and get overruled as sort of assignment or whatnot. So that's why it's structured like a advance plus interest.
Yes. I'm aware of that. I'm aware of that. So just.
That's a question for Sara. So I'm just interested to know if you saw happening in your sample of people using student loans as insurance after a bad labor market shock or something like that. So we hear a lot about oh, I don't have a job, but then if I get enrolled in this university, I'm going to get a student loan that's going to give me some stipend that I can live. And usually in order to get a student loan, you don't need to have a good credit score.
Oh, so you're reading my mind, because I actually have another paper about that. So actually in for-profit colleges. So that not in this sample a bit, but I've definitely heard that a lot, actually, that we think about, for-profit colleges and sort of taking advantage of people, but if you talk to people, not just for-profit community college, that is a way you go back to school, at least you have money to pay the bills until you get completely screwed right by the college.
Yeah, so that's the problem, right? So
right.
You go to school, you get a student loan and you have student debt, but then
right,
probably not able to pay.
Right, and I mean, depending on the school, very
right.
quickly might go out of business or something like that. But yes, definitely, I've heard that.
Mehrsa, I have a question based on something Sara said. So, Sara, you mentioned that people say banks are the bad guys, and I was wondering where does postal banking fit in with that? How do you think any banking option will be seen by people, and what is the alternative, and is there any forward country research?
Pew actually did some surveys on consumers, low middle income consumers, about how they would respond to postal banks, and turns out I think it was 80% of people would trust postal banks. And I think, there's evidence here that a lot of people avoid banks, not just, one is that there's a banking desert, so the postal banks alleviate that problem, but also there's class, intangible sort of barriers, and postal banks, the post office is just, you may think of it as inefficient, but it's certainly not hoity-toity, right? It's also, maybe it's a dinosaur, but it's not a shark, right? So I think it's, people feel certain things about the post office that I think are not accurate, like it's inefficient and bloated. I think those have been way overblown, but I don't think anyone out there thinks the post office is out to screw you. Not yet, at least.
Yeah, I had a question for Professor Greene about the kind of prescriptive part of your project, and you mentioned wanting to reward rather than punish self-sufficient behavior, and then there's this really interesting idea about kind of pausing the credit reporting process, and I'd be interested in hearing more about how those two link and what the kind of main driver of rewarding self-sufficient behavior is.
So that part of the project is still very much in the works, partly because I'm still collecting data. This is like but the idea based on talking to people is that if you think about bankruptcy and the automatic stay, right, consumer bankruptcy, because I didn't talk about that, the idea is that it's like, in some sense, you can think of it as a pause. Creditors can't come after you, and you get a chance to try to rework your finances. So the idea with this, in some sense, credit reporting automatic stay, would be that it's a way for when somebody has some kind of emergency, that sort of thing, to give them a chance without, for example, filing for bankruptcy, to get things in order enough so that they could smooth that, but then not suffer some of the consequences that I talked about, like not being able to get a job, because we see here, and other people have talked, it's just a very clear cycle. You lose your job, your credit report goes down, you can't get another job, you fall deeper into poverty. I mean, you talk to people, traditionally, some people at least think of people who are homeless as kind of, there must be some mental health issue. So that's, at least now, that's not the case. I mean, these are people, at least some of it, who have had jobs, and then they get caught in this cycle. And so the idea of this pause would be a way for people to, in some sense, catch up without the full bankruptcy. Partially, we know all sorts of, first of all, the stigma, but then also it's expensive to file, that sort of thing. So does that answer your question?
So our final question.
My name's Eric Schuler. I'm just, full disclosure, I'm with Oasis Financial, one of the consumer legal funding companies. And just got a couple of quick comments, if I may. On the question of showing consumers what percentage of the claim would be done, the problem, we've actually looked at that. The problem we have is that actually may be harmful to the consumer, and here's why. Is that the funding companies typically are more conservative of the estimate value of the claim versus their attorney. And what has happened is, and is happening, is insurance companies are subpoenaing funding companies to get copies of contracts on consumers and trying to skirt attorney-client privilege issues, things along those lines. So if we say a case is valued at, let's say, $40,000, but their attorney is asking for $100,000, the insurance company can come in and says, well, wait a minute. Here's a third party out here saying this is only worth $40,000. Why should we give you more than that? So that's why in some of the legislation that we've passed, we have actually extended the attorney-client privilege to the funding companies for the extent of the contract, because we've had several cases in which insurance companies have subpoenaed funding companies for their records on it. And the other problem with that with the consumer is the value of the claim is fluctuating. So in other words, we could estimate it at $40,000 based upon the information we have at that given point in time. But as the case progresses, we come to find out, well, it actually wasn't the shoulder injury from the accident, it's because of the football injury they did in college. And so that $40,000 is now down to $30,000. And go a little bit longer on, well, guess what? They went through a yellow light, not a green light. So that 30 is now down to $20,000 or whatever it is. So it's kind of hard to put that guesstimate value on the case in a document because of the fact that that's a fluctuating number. And again, the biggest reason is because it actually could go back and harm the consumer because we're being more conservative than typically what their attorneys are.
Yeah, thanks.
Well, one thing I wanted to follow up and say was, I think with data systems put in place, there's probably greater ability to predict I mean, I feel like with the insurance industry, we've seen them we know that they have a giant database, don't we? And that's sort of, we do recognize there's a cost to doing that. One other point wanted to make, I forgot about it. Go ahead, Paige.
Oh, no, I was just going to say thank you. We've been thinking very hard about how any kind of changes in the industry will affect consumers. It's complicated, right? There's the consumers, there's the attorneys, there's the funders, and there's the insurance companies, the big defendants. So, and you know, many very well intentioned policies have perverse effects or raise costs in the industry in a way that trickles down to harm consumers. So we're trying to think through when the rubber meets the road, how different policies would affect consumers. And I guess we're, like I said, the litigation process is confusing and complicated and uncertain. So we're just trying to figure out a way to get consumers better information at different points in the case. So yeah, thank you.
Chris?
The gentleman from Oasis, a question? I'm curious, just for the sake of discussion of the paper, if you were required by the United States to provide a Truth in Lending Act disclosure to your customers, what would the average annual percentage rate be that you would have to disclose?
The problem with putting an APR on this is it's difficult to do because in a loan scenario, you know what the beginning, middle, the end is.
Let me rephrase. If you had to give a retroactive, effective APR disclosure looking backwards in time after you're paid out.
But that's not TILA.
Okay, but let me just answer the question anyway. What would the interest rate be that you would have to disclose? If hypothetically you were required to do that.
I can give you a typical payback. So if we give someone $2,000, we'll typically get back that plus a premium of about $1,000, but that could be in 6 months or that could be in 6 years. So it all depends upon when the case is resolved and when the case settles.
So no, not going to share an average rate?
Well, it's going to be high.
It's going to be high, but the problem is it's hard to put an actual APR type rate on the product because the fact of it's not a loan product and you don't have a fixed maturity date that you can affix and saying when you go to get a car loan, you know it's 36 months, it's 60 months. If you get a home mortgage, it's 15 years, 20 years, 30 years. We don't know what that end date is, so it's kind of hard to fix an APR on it when you don't know what that is.
Well, I mean, I want to. If other people want to ask other questions, you could. But I've modified my question to look back in time. Like you would know at the point in time when you pay out.
I can just give you in Nebraska. We have to do reporting there, and the last reporting that was there, the companies charge anywhere between 43 to 62%. So I mean, it varies based upon the case settling, based upon a whole variety of different things. And I think the other thing you have to keep in consideration, where this is really different than a loan product, is one of the things that Gene said is there's no periodic payments. So the companies are not getting a steady cash flow in to them. The cost of capital to the companies is high because these are non-tangible products. And even though they get their money and they may not get the money back for 18, 24, 36 months, they still have to pay whoever they're getting the money from on a timely basis.
Okay, so I think that will close out the Consumer Credit in America's Symposium. Thank you again to Duke Law and to Law and Contemporary Problems for hosting us and for everyone for coming and sharing their important and timely work and for great comments, questions, and discussion. And I believe there will be cabs for those who ordered cabs.